It's great to be here. Can you hear me okay? I find this is a slightly unusual, but if it's working, that's good. Great to be here. One of the challenges of climate is this very complicated political geography. You know, the countries that are most vulnerable, have greatest, tend to be the countries that are not big emitters. Some of the countries that have the biggest potential for future energy demand and therefore critical for the transformation tend to be middle income, large countries that are not eligible for concessional finance. So you have this complicated geography. And so I think that it's important if we're going to try and reach some common views about what we need to do and what the challenges are. Let's focus in on one particular problem rather than all the problems, and let's talk about the planet, the planetary problem. How do we do the kind of investments to the kind of scale we need to make sure that temperatures are as close to not much beyond 1.5 degrees of global warming. So let's say that is our central question and the scale that needs. So there's been the independent high-level expert group, which has pointed out that we need about $2.4 trillion per year for developing countries ex-China. How do we, what instruments, what tools, what policies, how do we achieve that? And I want to kick off with Elan because I think there's been a tremendous change in the past 10 years because of technology. The economics of what we need to do has changed quite dramatically. Many of our ideas have came up at a time when the economics is very different, when doing climate action was in fact expensive. It didn't make great economics. You needed a public subsidy. And that's why many people develop these ideas around blended finance. We can't get this done commercially, so we're going to put in a big public subsidy. Well, since 2015, the economics has changed substantially. And that's why in developed countries, 81% of mitigation is being financed by the private sector. Not happening in developing countries. We can come to that in a moment. The IDB, Elena, is just about to publish this big flagship report called Peril and Promise, which is showing how the economics has changed. And indeed, if Latin America were to get to net zero in 2050, that there will be a net economic benefit to the region of $2.7 trillion, 50% of GDP. And I think that's a very important observation. So we're talking about something that has huge economic value. We tend to talk a lot about the peril and neglect the promise. But Ilan, what's driving those kinds of net benefits?
Hello? Can you hear me? Yeah? Okay. Thank you, Avi, for the question. I think that from the private sector, we see three different drivers of what's happening in the region and across the world in the area of climate change. First of all, we have a lot of investors, asset owners, asset managers that are looking to invest in sustainable projects. It is calculated that around $50 trillion of asset managers are looking to invest in climate-related or ESG investments. That's one part. The second part is that we have consumers, clients, that are trying to buy and to invest in their own consumption in sustainable businesses. And then you have the third part, which is the third component of this, that are basically the employees themselves. We all want to work in a driven organization, in a mission-driven organization. At the same time, I think that part of the conversation in Latin America is that we have some estimates that there is a $5 trillion opportunity of businesses between electromobility, water and sanitation, and different types of sustainable business and buildings. Basically, there is an opportunity here of new business models that there are a lot of capital that is trying to flow towards those.
So I understand from the report that part of this net benefit, a significant part, is the savings from electrification, the savings from getting out of fossil fuels. That given that renewables are now the operating costs significantly cheaper. Also, significant savings of health benefits, right? I mean, we kind of neglect the air pollution costs of fossil fuels. We've been focusing a lot on climate change and some of the challenges of that, but more people are dying from poor air quality in our region than are dying from climate change at the moment. So it's very compelling. Lots of returns to be had. Graham, why are we not moving forward at the pace we need to move forward to for the planetary purposes? What are some of the challenges that's stopping us doing that?
Hello. So, how many of you have actually read books on how technological revolutions actually happen? And I wanted to mention one book in particular, which is done by Carlota Perez, who happens to be a Venezuelan, but she actually has analyzed all of the technological revolutions that have happened over the last 250 years and asked the question, what do you have to do to be able to join and move that forward rapidly? And when you look at those technological revolutions over time, what you actually find is that first you need new technologies. You need something new. We have that. We have the technologies already. But the second thing is that you need the vision and leadership in the countries to recognize those new technologies and the opportunities associated with them. Because there's a huge amount, mainly public sector work, that has to be done to create the policy frameworks that would actually allow for the private sector investment to be able to drive the agenda forward. The third part is the finance. And a lot of the finance actually comes from the private sector, but you can only get that if the public sector is showing that leadership to move forward. So you ask, why is it not happening? I would say, actually, it is happening. Not quick enough, but it's beginning to happen. And I just wanted to give a few examples of where it is actually happening. So Chile is a great example. Costa Rica has a great long-term decarbonization plan. They've begun that process. It's national. And the idea of it is not that it's just about one government. It's got to be transversal to multiple governments. Chile is a great example of this because government after government is sticking to the same plan. Why? Because it's of national interest. It isn't about saving the world. It's actually because the governments want to do this. They see this as their competitive future in reality. So they're moving in that direction. But there are more examples. Uruguay is another example. Brazil now has a new ecological transformation plan that they're moving forward. Same concept. It's transversal to all sectors, but it's also long-term. Barbados has its roof-to-reef efforts. Colombia is beginning to move in this direction. Even Guyana, which is the country I was born in, has a low-carbon development strategy that tries to cut through different governments over time. So to me, that's crucial to move this forward. Then you need to think about what specific policies, what regulatory changes. That's also very country-specific. It depends on what your mixes are today, to see what your best mixes would be in the future. It depends on where you're sitting today. If you're completely dependent on fossil fuels today, then you're in a different place to Costa Rica, which is basically 100% renewables. So it depends where you are. It depends what you're going to focus on. Latin America is well advanced on the electrification side, but is just starting, not electrification, on renewables and electricity production, but is just starting on questions of electrification of transport systems. So it depends where you are and which country you're in, and it's very specific to those countries. The last point I'd make is, and I'll finish here, is that MDBs are super well positioned to help with those transformations. Because why? We have basically technical assistance resources that can help with the changes. Once a country wants to go in a particular direction, we can help with technical assistance to help them move and change policies. But we also have a very interesting tool called policy lending, which can also help countries deal with fiscal challenges linked to those policy changes. Those two together can really help that process accelerate and move forward. It's not happening fast enough, but we have several examples in Latin America that are beginning to move, and they're moving not because ministries of environment want to move it. It's actually the president and the ministries of finance that are really driving the agenda.
So well, before we go on to the other factor, I mean, one of the things, Graham, you often talk to me about is the need for joined up government, for government to be able to view this challenge as a single mission, cutting across different ministries with a very clear plan. And that the way to do that, and the current sort of language of describing that, is a country platform. That a country platform is about taking this transformation and seeing all the different ways it cuts across different ministries, different silos, different departments. Not easy to do in rich countries, not easy to do in developing countries. But is that the essence of a country plan? And if I have a country plan, is the point of that now I have a country plan, all these different external partners can participate in a single plan at different parts. The bits the effort for coordination is then becomes much less, because we all know we are participating in a single plan.
So I think there's two sides to a country platform. First side is that side where you have the leadership, the vision, the country wants to go in a particular direction, and they've begun thinking about what are the policy barriers, what are the changes we have to deal with, and then what are the investments that we need to be able to do that to move forward. That's the one side. The other side that is often complex for a government is how many external partners they have to deal with to be able to manage and move forward that agenda as quickly as possible. So the other side of the country platform is getting those partners together to support that vision to move the agenda forward. That means that they actually need to sit down and agree on certain things. I'll be a bit provocative here, but you might find that one group will come in and say you need to do carbon markets, and another group will come in and say no, you want to do something different, you want to do a regulatory approach, etc. We need agreement, because you don't want to confuse the agenda. You want to basically say, okay, we're all going to work together towards the agenda of the government to move this thing forward. And again, I repeat the importance of having the technical assistance, the funding to support the government to be able to organize. That can extend from, okay, how do I get the Ministry of Finance, the Ministry of Transport, the Ministry of Energy, the Ministry of Environment to work together? Because just like banks, they're all silos. They're structured in this way, and it's a hard thing to break down.
Yeah. So now we've dealt with that sort of background. Let's drill down to some of the issues that are often raised. And I'm going to, after I've described this cost of capital problem, I'm going to come to you and ask you about some of the work you're doing on reducing cost of capital in projects and de-risking projects. But when you look at the flows of finance across the developing world and into Latin America, it is strongly correlated, strongly related to where the high cost of capital. So the bulk of financial flows are happening in countries where the cost of capital is low. China is the one developing country where there's a huge amount of financial flows into renewables and no difficulty in understanding why, because their cost of capital is uniquely low. So why is the cost of capital high in developing countries? Now, the first thing to say is that what do you mean by cost of capital? At one level, it's a supply-demand. A developing country, almost by definition, is a country which has not a lot of savings and a lot of investment opportunities. Big demand, limited supply. The price is high. The cost of capital is high. So how do we, and as a result of that, something that is very profitable in a developed country where the cost of finance is low, that same thing, same technology, same contracts, everything the same. If you have a high cost of finance, that can become not profitable. And that's why we're seeing the relationship between flows of finance and cost of capital. So how do we change that? So some people say that, well, we need to develop local markets. And it's the nature of multilateral development banks. So a major part of what we do is try and develop local markets. But if the problem is that there's a lot of investment demand and there's limited supply of savings, coming in and saying, well, we must fund all this even additional investment demand locally is not going to solve your cost of capital problem. It's going to make it worse. So if we want to accelerate investment, and we're asking for a transformation that is one of the largest transformations ever done in humanity's history, we're going to need foreign capital. So how do we get this channel of capital flowing from where it is cheap and plentiful to where it is in short supply and expensive? And a lot of attention has been placed on dealing with the risk of projects. So that the obstacle to this capital flowing is concern about the riskiness of projects. And there are various ways in which people have tried to address that risk. And I know, Elaine, you at Investa, that's something you spend a lot of time thinking about. Could you give us an example of how you might, an example you like where we've managed to reduce some of the risk from the perspective of an investor?
Thank you, Avi. I think that I will take the opportunity that I have Eli Muslim here, who is lead on blended finance, and he does this for IDB Invest particularly. Because part of the issues that we see is that we're dealing not only with the cost of capital, but sometimes there is information asymmetries in the markets, or we need to try to use the blended finance resources that we have to be able to bridge that gap. So Eli, if I can pass on to you the word to explain some of the examples, the Uruguay case and maybe the Colombian case as examples of what we did with blended finance, that in fact, that's public money from donors that we manage.
Hello. Yeah, sure. Thank you, Elaine. So we have a couple of cases that go straight to your point about reducing cost of capital. One is in Uruguay, where over a few years we effectively de-risked a few projects ultimately so that international capital can come in. Originally, those projects were competed by the government of Uruguay. It was at a time when technology was still high cost. The contracting structure was new. You made this point, Avinash, about this being unusual. It is quite unusual. And Uruguay, of course, is a very small market, and so not terribly attractive to international investors. And so IDB Invest financed those projects with a combination of own capital and blended finance. And the blended finance piece was really about ensuring the credit quality of those transactions in that sort of uncertain format, and ensuring the economic sustainability of those transactions over the long term, because we as IDB Invest really wanted to make sure that those were a that the demonstrative purpose was served. But it was not. There was a little bit of resource mobilization at origination, but not that much. Right? That wasn't exactly the focus. But as those projects were constructed, went into operation, and were proved out, then there was an opportunity. We helped the sponsors issue B bonds in the market. Those were bought by international investors.
So this B bond is where people are co-investing with us. So
they're co-investing, but in this case, it's an actual bond. So this was bought by international insurance companies. They were relatively small tickets for an insurance company, but nevertheless, it was an important demonstration of interest in that market.
But just to make sure everyone understands what a B bond is, because we're talking.
Sorry,
so
thank you.
We're very used to that, but so we have a loan, but we're matching the terms of our lending with a bond, and we're getting private sector people to buy that bond. Is that? How
Yes, and in this case, institutional investors to buy that bond. And that happened over the course of a few projects.
And let me just interject very, very briefly. Sorry that for anyone involved in the climate negotiations, this is part of what we call direct mobilization.
Yes.
Of multilateral development bank money and the private sector.
Yes.
Sorry.
Exactly. Thank you. And by the end of that series of refinancings, the last refinancing actually had the local pension funds in Uruguay buying those securities. So you had both. You had international capital coming in, refinancing those transactions after we had de-risked them, and you had local savings coming in and buying those securities. And interestingly, the refinancing, although we provided significant blended concessional capital for those projects, the cost of the refinancing, the pricing of the refinancing came in lower than what we had originally provided with concessional capital. So you have this arc where you bring down the cost of capital over time in a small market. So I'll stop there.
Great. Now let me, development banks. Our history was very much as project financiers. So if you say to a project financier, the cost of capital is high, we're thinking, well, how do we reduce the risk of the project? And then maybe the sector that the project is operating in. But interestingly, we now have a lot of data of finance. And if you look at the cost of capital, look at the data that the IRENA and others have produced, the IEA, the cost of capital for a, can you hear me? The cost of capital for a renewable energy project is actually not much greater than the cost of capital to finance the government in a developing country, which is telling you that there are significant costs of capitals of the project, cost of capital extra of the project, but the cost of capital of the country risk is significant. Indeed, across many countries, the country component, so I can take the total cost of capital of a renewable energy project, and I can subtract from that the cost of capital of lending to the country, and what I've got left is the project risk. So I've got project risk, country risk, total risk. Country risk is about 3 times project risk. And that's a realization people have only now occurred in the past 2 or 3 years. That's why in the G20 reports, you're now hearing people talking about local currency, foreign currency, how are you dealing with country risk issues, country credit risk issues. People are now referring to talking to the credit rating agencies and currency risk issues. We launched a project in Brazil where we are trying to reduce the currency risk issue by basically saying, do you need to hedge the currency if we make a commitment to you that whenever your currency falls, we'll lend you cheap dollars, US dollars in a long term. And we will work on a country platform with your regulator to make sure that you have the ability to raise your prices with inflation. Because a very long term, 90% of currency risk is inflation risk. So if we worked on a country platform to deal with inflation risk, then, and we're also coming in and lending US dollars at times of stress, the projects may not need to hedge the currency, and they could save 10 percentage points per year of hedging costs, which would dramatically change. So that's where that whole set of ideas are out there about why cost of capital is important, foreign exchange is important, project risk is important. Let's turn to one other aspect about cost of capital, carbon taxes. So you hear some ideas out there that there should be a global carbon tax. Carbon is creating social problems. It's not in the private price of their activity, let's bring that social cost into the private price by having a tax. The taxes work domestically. Let's have a tax. And let's have a single global tax. That doesn't make sense if you've got different costs of capital everywhere. Because what drives investment decisions is relative prices, not absolute prices. In a place with a very high cost of capital, you charge a high tax for carbon, and what that does is stops the investment full stop. In a place with very low cost of capital and a high carbon tax, that leads to investment switching rather than investment reduction. So that's why cost of capital is an important concept. It changes how we use taxes. It means that maybe we have different taxes in different places. It may be why the evolution of carbon taxes is linked to carbon border adjustment mechanisms. So that you have one tax when you are going to another country, but you may have your own tax domestically. So it allows for differences of these different things. Let's talk a little bit about how we reduce the cost of capital for public investments, Graham. So we've talked about cost of capital being an issue to get the private sector. How do we reduce the cost of capital to get governments to borrow money for creating climate resilience? You've been working on something called Bid Klima, which is about governments maybe investing in a big public infrastructure project, but managing to lower the cost. And how do you manage that?
So, I'm not a finance person. I'm a biologist, actually. But anyway, so I'm going to give you a very simple explanation. Conceptually, it's not that hard to understand what we're trying to do. So what we're going to do is actually cover part of the cost of the capital through a grant to the countries so that they can cover some of the cost of the capital once they have approved the loan and moving ahead. But what we want in return is that they actually deliver what we tend to call 3 KPIs, 3 key performance indicators, that go beyond the project itself, that are actually related to some of the things that we've already been talking about. One of them is that they need to connect the operation that they're doing to broader ambition, to the NDCs, in the case of resilience, to resilience goals. So they have to make that connection between the project itself and the national or subnational objectives of the NDCs. The second thing is, which I already mentioned, is they need to show that actually the sector ministry is in fact working with the Ministry of Finance, is in fact working with the Ministry of Environment. They have to show that. So we have indicators that actually will test whether or not that's happening. Why is that important? Because that's practically impossible to get. It's very hard to get, but now you're incentivizing it because you don't get the reduction on the cost of capital or the grant to reduce your cost of capital unless you deliver that particular thing. The third thing is that they need to develop a monitoring, reporting, and verification system so that they can actually report on what they're doing in the country in terms of the ambition, the governance, and moving ahead. Again, this is practically impossible to get. We have grants from GEF, the Global Environment Facility. They're giving back the money to us because they can't spend it. You give it to the Ministry of Environment to develop an MRV, it doesn't happen. They just can't spend. They develop something that goes on the shelf, or they're reporting on things that happened 10 years ago. It really is not very helpful because it's the Ministry of Environment. When it's the Ministry of Finance that needs this, the Ministry of Environment will deliver it. So you're actually driving that connection, so you get your MRV at the end of the day. Why is all of that also important beyond the project, beyond the effects that we're getting, is that if you have those pieces, you have the basis for doing basically sustainable linked bonds in a country. You create the capacity in the debt management offices of the ministries of finance to actually go out to the market, as have done Chile and Uruguay, to get bonds off the capital markets. But you have the system for reporting, you have the transversal governance, you have everything in place to be able to do that. That takes a long time to develop, but the idea of this process is to be able to build that out. That is an extra added benefit to be able to access. Why is that important? Because actually, these bonds do have a reduction in cost of capital. I mean, we can talk a little bit about whether or not green bonds have greeniums and things like that, but the reality is that this is a way to reduce your cost of capital and do it over the long term. So we have a pilot. We've put, I think, $1 billion, well, we're running $1 billion, up to $1 billion of our own capital in this. And not only do we give a grant to reduce that cost of capital, but interestingly, we also give a grant to build this capacity. It goes back to that technical assistance. The government isn't in a position to find $1 million to be able to move this stuff forward, so we provide an extra $1 million on top of this to be able to help them move this agenda forward. It's a pilot. It's an effort. It's trying to work out whether or not we can get good results. Are we getting good results? Interestingly enough, you find lots of synergies with the blended finance world as well. So we have 2 projects that are working very well with the climate investment funds, for example, which are already dropping down that cost of capital in the country as well. So that's an interesting finding. There's a couple of other ones. I think for a country that wants to move forward, again, I come back to this point, the country has to lead these processes, has to be the one that's moving it forward. It gets them to focus much more on transformation, because you're connecting what happens in the project to what should be happening in the country. That's a key advantage too. And the last point I'll make is it focuses on results. It's not so much about what you put in, it's actually what you get out of it at the end of the day, which is one of our major issues as well.
And that's why sustainability bonds are sometimes called, a part of the genre of rewards for results instruments. I'm going to say a few words about debt swaps as another way of perhaps reducing cost of capital. And then I'm going to come to you and ask you for any questions and thoughts you have. And then afterwards, we may talk a little bit more about markets. So debt swaps have become very, very fashionable. We've done a big one in Ecuador, a couple in Barbados, and there's some others on the way. Essentially what a debt swap is a country has, say, a piece of high-yielding debt, say 10% yielding debt, and someone like the IDB will say, I'm going to guarantee, but an IDB guarantee, Inter-American Development Bank, AAA-rated guarantee on a piece of issuance, which means you could borrow money at 5%. And with that borrowed money at 5%, you could buy back your 10% bond. So now you've got this big savings. You were paying 10%, and now you're paying 5%. But I'm only going to do this if you use those savings in on a particular expenditure for marine conservation, for nature conservation, regeneration, for climate sustainability, resilience, etc. What's very important about that is that, yes, the country then gets the ability to spend on things it wasn't otherwise going to spend money on. Its debt service hasn't really fallen very much. We've just redirected payments from paying back the creditor to doing something domestically. So that's good for the country, but it's not a debt solution. Too many people think a debt swap somehow magically solves your debt problem and solves your climate problem. One of the things we learn in economics is you can seldom do 2 things with one policy. It is a way of generating a little bit of additional resources. Where you've got a pocket of high-yielding debt. Imagine a country doesn't have high-yielding debt. Well, you can't really use a debt swap because a debt swap's about the difference between the cost of your debt and the guarantor. What about if a country has lots of high-yielding debt? Sounds like you get a lot of potential savings. Except a country with lots of high-yielding debt needs to restructure their debt. Because if you do a debt swap and you've got high-yielding debt, and you've swapped it with a AAA-rated institution that has preferred creditor status that you can't default against, you've locked in your very high cost of funding. So debt swaps work in that that sort of band of your debt. You've got pockets of high yielding debt. You don't have tons of high yielding debt. Not all of your debt's high yielding, but it's also not that you have no debt problem and that you have no high yielding debt too. So let's stop there for a moment and ask you if you've got any questions before we go on to issues of markets. So any questions on climate finance? Yes. Can we get a mic to the gentleman over there? Great. Thanks very much.
Great, thanks. So I work in the private renewable energy sector, and I wanted to come back to the point that you made about how the project risk how the risk for renewable energy projects is the sum of the country risk and the project risk. But there at least two examples come to mind where that's not necessarily true. For example, you look at a country like Ukraine, where it's probably not even rated as a country sovereign risk, but you have a lot of renewable energy projects going on. Another example is Egypt, which has a cost of capital on the sovereign risk in high double digits, and yet renewable energy project debt goes at high single digits. And so what it shows, in my opinion, is that people are more likely to pay their electricity bills in a properly structured electricity market than country is likely to pay back its debts. And it sounds to me a little bit like if we focus too much on this stacking country risk on top of project risk, we take away our focus on the actual issues with the electricity markets and energy sector at large. So do you agree? Do you disagree? And how would you approach that?
Well, one of the challenges is the way the rating agencies and the financial system works is that rating agencies have what they call a country ceiling on the rating. So you may have a very well credit enhanced project. It's got lots of guarantees, but the country has a poor credit risk. Then that project can't have a credit rating that is higher than the country. And if you are a lender in Europe, if you're an institutional investor in Europe, your regulator doesn't take into account these guarantors, these guarantees when it sees that credit rating. So you've got to put up capital. Even though it's a fantastic project with all kinds of guarantees, you have to put up capital to make that investment if you're an insurance company in Europe or a pension fund. And so the cost of capital doesn't get to go down because the country risk is high. If you look at the data from the IEA, then the vast majority of total risk is above country risk. There may be some pockets of differences, but the vast majority are that. So the macro risk is important. I mean, we have to deal with the micro risk and the macro risk. But one of the things we're trying to do is engage regulators in Europe and the United States, banking regulators and insurance regulators, to make sure that some of these anomalies aren't there. Because if a project has great guarantors, then why should we, just because of some convention, have a different credit rating? Did you want to? So I think so I think it is still a big issue, and we can't get round it from trying to credit enhance the project and not the country. And when you speak to the rating agencies, what they'll say to you is that, okay, you may have a great project, but if a country is falling apart and there's riots on the streets and there's people rioting for food and energy, you may have a great project, but you cannot insulate yourself from macro environments. And we've seen some of the tensions around the world. I suspect Ukraine is not a great example to draw for the rest of the world because of the very particular circumstances there.
Hi, thank you so much for this session. It's been so informative. I just wanted to link everything back to what's happening across from the pavilion here. So we're, of course, negotiating the new collective quantified goal. And Avi, I've read a few interviews of yours. You always talk about how the MDBs can link back into the work that's happening inside the NCQG. So I'm just wondering, because you answered a lot of the questions that we're asking there. So cost of capital is a big one. How do we use the MDBs is another one. And of course, the UNFCCC can only dictate to the multilateral climate funds. So how do we involve you, and how can we link all of this back to the NCQG? Thank you.
So within the, I think what's evolving with the new collective quantifiable goal is an interesting change where we were going to have two numbers rather than one number. We're also going to have an interesting change, and an important one, where one of those numbers is going to relate to needs. New quantifiable collective goal is the new 100 billion. The problem with the old 100 billion is it became an irrelevant number to climate finance, right? I mean, 100 billion, you need 2.4 trillion, you've got a $100 billion dollar number. So there's going to be an outer number in the new quantifiable goal, which will be a number related to needs. It may be $1 trillion number. Cross-border finance, $1 trillion. But developed countries, I cannot, all of their aid is $200 billion. How do they go from 200 billion to $1 trillion? So there's going to be another number, which is a bit that they commit to. And in that commitment, and Graham has been working very hard on this in the past few days, a key part of their commitment is their...
It's not working. No.
Their contributions, the developed countries' contributions to the capital of multilateral development banks, and from that, the amount of lending that follows, that will be part of the NCQG number, and in direct mobilization of multilateral development banks with the private sector will be part of that number. And that's how you might get to a $300 billion figure, 3 times the 100 billion, but not $1 trillion. So I think that's how that's evolving. I don't know if, Graham, you want to say anything more on that?
Yeah. No, I just wanted to go back to one of the points that I was making before, is that MDBs are not just about how much finance they deliver directly in terms of the money that's flowing out the door, that it's the power of an MDB actually comes from their ability to work closely with a country that wants to change with the technical assistance to be able to help accelerate those changes in a country, because that is where you'll get redirection of public finance, so domestic public finance, but also it's how you set up the systems, enabling systems to redirect private finance as well. So I think that is a crucial function that MDBs have a comparative advantage of working with countries to actually deliver. So it's not just about the number. It's about the role of the MDBs and being able to help with that process. And that's, I think, to be completely honest, that is where our greatest impact is. It's not the direct investments. If you want the numbers straight for Latin America and the Caribbean, we calculated, and I think it's an underestimate, they need 500 billion to 1.3 trillion every year. The MDBs provide 15 billion. So that direct investment is a literal drop in the bucket. It's about 2% of what's actually needed. Even if you were to triple it, that would make it 6%, let's say. That's not solving the problem. But if the MDBs are helping countries like Chile, Colombia, Uruguay, Brazil, all of these countries to change and to create the systems that then allow for those foreign direct investment flows, allow for the private sector flows, but also many countries still don't even track how they spend their own public finance. They don't know whether or not it's a positive spend or a negative spend. and I'm going to use this opportunity to flag that, fossil fuel subsidies in Latin America and the Caribbean are basically $100 billion a year direct and $300 billion a year indirect. So when we start talking about numbers, why aren't we looking at that number? That's a very big number. So anyway.
And I just wanted to compliment the fact that in addition to what we're doing with countries, IDB Invest is developing a new business model that it's called Originate to Share. Basically, because we know that we want to scale the direct and indirect impact of private capital in our region. And that means that we need to create the asset and work with clients, not only in the countries at the country level, but with clients, developing the asset, investing in the assets, determining what the KPI is, and then also bringing and mobilizing private capital to then follow to a different asset. That means we want to grow from 80 transactions per year to 250, 300 transactions per year to be able to generate the specific investments that we need to tackle climate change.
Thank you. Question there.
Yes, thank you. It was very interesting. So far, you talked mostly about investing in public and private projects. I'm an entrepreneur in the textile industry, and I have a startup. I was actually interested in how do you make sure that startups and scale-ups also get access to this huge amount of money that's available for sustainable projects? And I wanted to ask, how is that in terms of risk profiling? Because I know that for startups, it's much more difficult to get the same amount of data and information that larger companies already have.
Well, traditionally, multilateral development banks have not been in that space because we are a little bit clunky. We work with governments and policies, and so the nimbleness that's needed to work with a startup. But there's been a recognition, and this is closer to Elaine's area. There's been a recognition that that's an important place to be. So firstly, we are investing heavily in what's called project preparation facilities to help projects develop. And secondly, we've created a brand new part of the bank called IDB Lab, which is specifically designed to deal with more startup type projects, especially where there's a new technology involved and it's harder for the private sector to recognize this burgeoning new technology. Something else you want to add to that?
No, and I think there is this continuum that we see between IDB Lab that has resources for venture capital until they grow and basically graduate from IDB Lab and pass to IDB Invest.
Any other questions?
I just had a comment that builds on the concept of continuum. This is still so odd. No, I got this. Thank you. Which is that I think...
But you're sounding really good.
Oh, thank you. I think what gets lost, not by any of the panelists, but in general, in the concept of mobilization is that we are on a continuum. So when we think about Originate to Share at IDB Invest, it is to some extent taking advantage of an interest in among investors to invest more in the region, to invest more in emerging markets, to invest more in sustainability. But that is one step along the way to having the trillions of institutional investment come into emerging markets. And as you go up that scale from, let's say, what we did in Uruguay to Originate to Share, you get increasingly to the space that you were just talking about in the answer to the earlier question of credit ratings. Right? And that at some point, so when we de-risked those projects in Uruguay, and they ended up in a portfolio of an insurance company, the insurance company wasn't investing, wasn't thinking about the de-risking of those transactions. The insurance company now takes those projects into its portfolio and now assesses that country risk, right? And when it moves forward. And so it's a very different understanding when we as IDB Invest or at IDB helped the countries and helped our clients de-risk transactions and set up those country programs so that we can attract capital. It's then at that, we are doing that de-risking. But then it's at that stage that the institutional investment community at large looks at those credit ratings and says, okay, can I handle that risk or can I not handle that risk? And so that resource mobilization is a whole other step change that we are still trying to get to.
Great. So let me just say a word about, following on a little bit from Parry's question about the multilateral development banks and this whole NCQG process, new collective quantifiable goal process, which is one of the reasons why the developing countries, governments as a whole, like to use the multilateral development banks, is we have leverage, right? So basically, this is a scarce capital problem. There's not a lot of money, and when they put $1 of money into a development bank, they get about $6, $7, $8, $9 out. You put $1 into a fund, you get $1 out. Now, why is that? So $1 of capital in a multilateral development bank, we use that capital. So what is capital? Capital is, can you still hear me? Capital is loss absorbing. Capital is I can lose that money and I don't need to pay it back to anybody. So when you got a mortgage and you've bought your house, if the house goes on fire, in many countries you still owe the mortgage company. Still got to pay them back. You haven't got the asset, but you've got to pay it back. Capital is that thing where it's your money, it's your equity. You don't have to pay anyone back. So the markets then say, well, you've got $1 of capital. I will lend you $7 on the back of your $1, because if anything goes wrong, your dollar is the first to lose the money. So my $7 is protected by your capital. That's how we have leverage. And that leverage is very powerful. So that's why the multilateral development banks are in this game of scarce money. Let's talk a bit about markets. And we talked a bit about taxes. And one of what we're trying to do with taxes is change the price of carbon. That if the government isn't involved, the markets aren't pricing carbon as if the world's about to disappear unless we do something. So the taxes changes the price of carbon. There are other ways of achieving a change price. We can use a market. We could say that all existing, if you want to use any more carbon, you need to buy a permit from someone who's not using the carbon that they previously used. Cap and trade. So that's another way of doing it. And markets and taxes. But here's the thing: they work within a jurisdiction. Because you've got legislation. What's happening with these microphones? We've got legislation that allows you to do that. What happens across border? Because remember, I mentioned before, a developing country will find it hard to use these systems because they've got a high cost of capital. You charge high taxes. You lead to investment reduction on investment switching. So we have a cross-border carbon market, and that cross-border carbon market is a voluntary carbon market. The problem is that it's voluntary. And because it's voluntary, the price of carbon in the voluntary carbon market is very, very low. It's about 2% of the price in the legislated market. So in Europe, the price for carbon is $80. In the legislated market, the compliance market. In Canada, it's similar. In the voluntary market, it's $2, $3. And because it's so low, because it's voluntary, no one's requiring them to do it, there is not much space to invest in integrity. And so you get a combination of a low price and some concerns about, is this market real? Have you measured it properly? Are you enforcing it? Are you monitoring it? And we've had various scandals, whatever. And that's why the voluntary carbon market is so tiny. It is, we need $2.4 trillion. The entire market is $2 billion per year and shrinking. And so we need carbon markets are very important for the future, but we need ways to make them more compliant like markets rather than voluntary markets. There was a question right at the back there.
Now?
Yep.
Yes?
Good.
Okay. Thank you very much. I am from Argentina, and I would like to ask you what innovative or disruptive financial instrument you imagine could work to preserve the second largest ecosystem in South America? Because our great American Chaco is being deforested exponentially and increasing emissions. And if countries do not have the economic valuation of the ecosystem services of the region, how can we think of the financial tools? Thank you.
Would you like to have a go at that, please?
Yes, you should.
You should.
So Juliana is our representative actually in Argentina and has been working on that specific issue and in particular on innovative financing mechanisms, which we've been discussing with the Global Environment Facility. So I'm going to pass it to you.
Well, actually, the question was meant to be for them. So actually, we've been trying to put together something for the Gran Chaco, not just everybody know when she's talking about the second biggest ecosystem is after the Amazon forest. We have the Gran Chaco, which is the second biggest forest region in Latin America. Is the biggest in terms of deforestation, so there is a huge challenge over there. And how can we actually promote like a completely change of the agriculture mechanism, agriculture production to be able to be compatible with the conservation of the ecosystem that we have. So it's a big thing. We don't have a formula for that. But somebody also needs to pay. We understand that if you have a land, of course, all the owners, the landowners, want to produce. So how can we? Some people would say compensate. Some people would say conciliate forest with production. So there are different ways of addressing that. We don't have a formula yet, but we do need to tap in private sector and financial market resource, because government money will never be enough to actually address that problem. So I will leave there.
And I think that's brutally honest. I mean, we can value it. We could value the eco-services offered by the forest. We can put a price to it, and we could have a credit, a nature credit, based on that value. But at the end of the day, those things are just, someone has to pay. Someone has to pay for it. They're ways of dressing up a payment.
Okay.
And unless we have a market for people prepared to pay, they're required to pay, they're enforced to pay, they need to pay. The evidence so far is that those things are not generating the kind of revenues and payments we need. As Juliana said, we need something. We haven't yet got it. It's not just, people think it's all about just value. As long as you value it, it's okay. And the problem is people aren't valuing it. Well, we can value it. We can put a value to it. The question is, who is going to pay for it at that value? Do you want to add anything to that?
So I think there are a lot of efforts looking at how you can innovate in financial terms. And if you went to COP29, you would have heard us talking a lot about innovations that support biodiversity, that range from the debt for nature swap guarantees across to species bonds, which the World Bank pioneered, but we're also beginning to look at in terms of like a Jaguar bond and things like that. So I think those things can help. And if you compare climate to biodiversity, your scale of how much you need is completely different. So I don't think those necessarily will solve, none of those are a silver bullet to solve the climate issues, but they can be very, very important for adding financing to cash-strapped groups. I mean, carbon markets, for example, have been very important in Colombia to be able to move the agenda forward. Even if it is only $2 billion a year, it doesn't matter, it's still money that you didn't have before. The debt for nature swap in Galapagos, I worked in Galapagos for 4 years. Everybody's always looking for money. $400 million in a trust fund, frankly, has never been heard of before. That's great. That helps substantially moving the agenda forward. But I don't think it solves the problem. And the problem for Latin America is particularly acute in terms of land use, the loss of forests as a result of, in essence, the agricultural infrastructure models that we're using today. What I personally believe, and this may be a little off the wall, is that you need the same thing that happened with energy to happen in agriculture. You actually need a model, a new way of doing business that is profitable. This is the big issue. It isn't going to work if it doesn't make sense to the private sector. It has to make sense to it has to be profitable. So you need a new model of doing agriculture that is profitable, that can contrast with business as usual. Unless we get that, we are not going to solve this problem. Because that's where you get your scaling, that's where you get now, governments can help to create the frameworks to be able to move that in the right direction, but I do not see that model yet.
Sure. Can I just one thing just to reinforce that point that Graham has made? 90% of the deforestation happening in the Amazon is illegal. So it's not just about getting the right laws. It's illegal already. But we could come in and have law enforcement, but unless you've changed the economic model for the livelihoods of those people, it will keep on coming back. So we have to have laws, enforcement, but a changed business model. And we need to do agriculture in a sustainable way. And we need to somehow make unsustainable agriculture costly to do. Sorry, Elaine.
Yeah, I was just going to compliment that new business model, especially in agriculture, it has to take into account the time lag between silvopastoral practices that will take time to grow, the trees to grow, and actually getting the yields and productions that you need at the end. Not that you cannot complement one thing with the other, but right now it's not exactly the same as renewable energy, that you design the project and you have electricity immediately. Here is a combination of cultural issues and also a time lag until we start producing the same amount of yield as before. So we just have to put all hands on deck to find that business model.
And you know, one of the other things about the sustainability, we've had a huge sargassum problem in this part, in the sort of Atlantic Caribbean Sea. One of the big factors, and that's ruining tourism-based places, it's ruining marine industries. But one of the contributory factors to that sargassum is the fertilizers that's being used, the runoff of that fertilizer into the Amazon, then into the ocean. So the sustainability is on multiple levels, and the reason why we're not capturing that is because it's a cross-border issue. The people suffering are not the people contributing. There was I think a question in the back there, and I know there's a question in the front too, but at the back first.
Thank you. Firstly, for this very interesting panel. I'm from Brazil. I would like to issue a matter of relevance, which is the foreign exchange volatility. Like many countries in the region, we may face some foreign exchange risk regarding concessional finance and high hedging costs that may increase the costs of financing for climate action. So I would like to know from you what kind of innovative mechanisms or frameworks do you envisage to reduce this kind of burden on developing countries, because you receive finance in strong currencies, but when you have to pay, sometimes you will face devaluations in foreign exchange. So the concessional, for example, concessional loans become much more expensive than at the beginning. That's my question to you. It's a difficult one.
Well, it's a great question, but Brazil is actually leading the way on this issue. So I feel like I should be asking you the question. But so I mean, here's the for the wider audience. Here's the problem: we want people to go away from fossil fuel investment into renewable energy investments. One of the important differences is currency. Fossil fuels are priced in US dollars. An investor investing in a fossil fuel type industry could sell the product locally or foreign. It's a foreign currency revenue earner potentially. Renewable energies are local currency. Renewable energies are paid for by the consumers of the utility company. So if you're a foreign investor, because the amount of investment we need is more than it's available locally, you're a foreign investor, foreign capital with a local currency revenue. So now you have a currency risk. Brazil is an example of a country with markets, liquid markets. There's a foreign exchange market. You can hedge the foreign exchange risk. The cost of hedging the foreign exchange risk is 12% per year. So if you need a 8% rate of return, and you're a U.S. investor, you need an 8% rate of return. You actually need a 20% rate of return. That project needs to generate 20% because you're going to pay about 12% in hedging your foreign exchange. And why is it so expensive? Because the currency actually only falls by about half of that. And the reason why it's very expensive is that we have a very interesting asymmetrical international financial system. When Europe gets into trouble, then let's say there's an economic shock. The central bank can lower interest rates to try and boost investment. The government can start spending more money. Policy can be counter-cyclical to reduce the amplification of the shock. In Brazil, economic shock, money flowing out of Brazil. The central bank has to raise interest rates to keep the money in. The fiscal authority has to spend less money to make sure it's credible on the international markets. So they amplify the shock, and the currency markets respond. You're an investor now observing that when I invest in Europe, the European country, be it Greece or Italy, big debt problems, more debt than Brazil has. Greece and Italy have more debt than Brazil does, but Greece and Italy have a higher credit rating than Brazil because they have international safety nets that Brazil doesn't have. So what we've been working with the Brazilian authorities is we've come up with something called the FX Liquidity Facility, where we work with projects that can raise their prices with inflation, renewable energy projects raising their prices with inflation. 90% of long-term exchange rate risk is an inflation risk. And we then say to the project that we will offer you US dollars at our cost of borrowing US dollars, not your cost, which is much higher. And we will lend you long-term those US dollars whenever the currency is weak. So now as a project, you don't need to spend 12% per year hedging your foreign exchange. You don't need to generate a 20% rate of return just to deal with the foreign exchange risk. And we're hoping that will help to attract more money into these projects and allow us to do even more renewable energy. There was a question here.
Sorry, I actually have two. One, we've talked a bit about sustainability linked bonds. We've talked a little bit about how you can use finance to reward good behaviour, including the grants that you do. I wonder what your views are as a panel in what has been a fascinating discussion on whether or not there is a place for all international concessional finance to be linked to sustainability outcomes, because that seems to me to be a potential game changer. And the other one really was around partly this idea of startups, partly this idea of how do you change some of these behaviours around, you know, lots and lots of people, for example, the agricultural model, the deforestation. What role for the MDBs in that sort of intervention? Can the MDBs do any kind of de-risking of multiple small actors in order to bring about that sort of cultural change? Much harder than getting involved in de-risking very big infrastructure projects, but I'd be really interested in your views.
So I'll answer your question by perhaps inviting you. I think we have a session which we can share with you that's that's actually on how the MDBs together are actually rethinking the focus on input indicators to results indicators as part of a joint process. So we have a full session that's going through that at some point. I just don't have it in the top of my head exactly when it is. But I think that's the first step. I will say within the IDB, I don't think we call it a group anymore, but IDB and IDB Invest and IDB Lab, we're actually looking at it from a top-down perspective. It's part of our new institutional strategy to actually start talking about scale and impact. And of course, if you're going to talk about impact, you need to talk about results, not about outcomes, not about how much climate finance we put in, but what are we getting from it at the end of the day. Interestingly, we've done some, I would say, initial changes to our impact framework, which include, in the past, what we've done is we've counted how many projects or what percentage of our projects are actually contributing to climate action. We've removed that indicator completely, and now we're asking the question, how many of our projects are actually contributing to building adaptive capacity, to building climate resilience, but not based on measuring the climate finance, but actually based on also measuring whether or not you're actually getting results, what your indicators are in your project. So there's a lot of discussion on, it's a work in progress, it's not complete yet, but there's a lot of discussion on that. That doesn't change the whole world in terms of things, but if the MDBs can lead the way, then that's a starting point.
And can I add to the second question? We do not work necessarily directly with SMEs or MSMEs. We work through financial intermediaries that work with SMEs and MSMEs in the region, because we understand that, yes, on the one hand, we work with projects, but to get to small farm holders, we need to get to them through financial intermediaries that are localized. So that's how we are working on.
But I just want to make a mention, because you mentioned this bit about whether all finance is sustainable, which of the current 0.1. So about I think is that climate. Of our component. And I think correct me wrong. If it's drug, there's things with time, but it's reducing. People and climate negotiators say are climate concrete is one of the worst forms of emissions, and so one has to be I think we have to be sensible about this. We're trying to do sustainability in everything we're doing, but we can't assume that everything. It may be that you have an emergency thing you need to do to patch up a grid, which if you don't patch up the grid, there's going to be communities that will not get access to energy at all. Without access to energy, you're going to have serious social health consequences, and we can't say, well, we're not going to do that because that's not going to reduce emissions. So I think we need to be trying to have a more sustainable and have more, that should be a priority and an increasing priority, but I think exclusively will be tough to do. Is that fair? Okay, so any other questions? There's a final thing I wanted to bring up. I see Akshat in the audience there, so I thought we probably ought to say one thing about insurance, because he wrote a very interesting piece about insurance the other day. So, we're in a world, I sometimes refer to them as magical illusions. Basically, we don't have money. So people keep on trying to come up with ways of doing something without new money. And they keep on hoping that someone else will pay for it. And that's the essential problem with climate finance, all these fancy ideas that someone else will pay for it. So I know I've got a forest that I need to pay for something, and maybe I'll invent something and someone else will pay for it. Unfortunately, they're not. Graham mentioned the greenium. So we issue bonds, we call them green bonds, but the reality is the yield on the green bonds are not considerably lower than on the yield on non-green bonds. What is the point of the green bond? The point of the green bond is that by classifying something as green, I will attract a cheaper cost of capital, and as a result of things being cheaper, I could do more. So but if there's no premium for calling it green, because I'm not attracting a set of investors enough to lower the yield, I'm not getting as much as I want. Well, one of the other magical illusions is insurance. So people think that the insurers will pay for disaster. You only just need to be insured, and somehow the insurance companies will pay for it. And you often hear them say that there's massive pools of capital waiting to come in to developing countries. And I say to them, waiting to come in and lose money? I mean, these people are sensible. They've seen the actuary numbers. They know the risks. That could only happen if they don't know the risks. And that they're insuring things where they're systematically making an error all the time. Well, insurance companies don't do that. And now they know what the risks are. Insurance at no point is about reducing your cost. It's about redistributing your cost. It's about spreading your cost. If you think about car insurance, at the end of the day, for the average person is that the payouts from their car insurance should equal the premiums. There's no magic to insurance. It's just that rather than you having to pay a massive amount and a big accident in 5 years, you've spread it out every month, every year. It's about spreading it out. So if you're talking about a risk where the risk is rising exponentially, climate change, and the frequency of the risk is rising rapidly, your premiums have to rise rapidly. There's no magic to it. In fact, where the magic is not in insurance, it's investing in resilience. The work that Graham and other people have done have shown that $1 invested in resilience saves a country between $7 and $13, is that right, Graham? In future savings. That's your best insurance, investing in resilience. And countries need the ability to invest in resilience, either because we have new low-cost instruments like Bid Klima, and the other constraint, the final thing I want to talk about today, is the debt sustainability analysis. So many of the countries that are climate vulnerable and need to invest in resilience are heavily indebted, because up to now, they have been dealing with loss and damage and climate by getting more in debt. So the IMF and the World Bank and others use a debt sustainability analysis, which says invariably that your debt to GDP ratio should be 60% in the long run. And the problem is, let's say your debt's above that. They're basically saying, using that analysis, that you can't invest in resilience, which seems perverse, because investing in resilience will actually save the money in the future. So we have a debt sustainability analysis that may be imprudently stopping people making prudent investments. So we need to somehow look at that debt sustainability analysis to make sure it's not stopping us doing the right things. It shouldn't be an excuse for spending on anything, but it shouldn't stop you doing an investment that should be saving you money in the future. So maybe they need to weight the debt depending on how much savings it generates in the future. Maybe they need to have different levels depending on different targets, depending on what you're investing in. But it can't be as simple as all debt is equally bad and stopping you making critical investments. So, if there are no final questions, I want to thank you all for coming and listening to us talking about these issues, and let's continue to have this dialogue and talking about these things, because we have a big task to do in climate finance, and there's no shortage of needs and hopefully of ideas. Thank you very much.